Hey, good morning. Good morning, everyone, and welcome to our webinar. Thank you for joining us today. I'm James Harris. I'm a managing director in A&M's Exec Com practice. I'm joined today by Alex Garden, senior director. The purpose of today's session is to give you an update on all the latest trends around executive remuneration that we're seeing in the UK market. Keep you right up to date. We have a lot to cover today, so we'll go through it pretty quickly. So it might feel like a whistle-stop tour, but we've got a lot of good stuff to get through. Please feel free to ask questions as we go along. You can either put them in the chat, which everyone can see, or you can use the Q&A function, which will send questions directly to myself and Alex. So feel free to do that. The session is being recorded, and we will distribute the recording. We will distribute slides. So you don't need to be frantically writing down anything you see. We will distribute all that after the session. So without further ado, let's crack on. Who are we talking about today? We're talking about the first 100 DRRs to be published in this AGM season. It's broadly even split between the FTSE 100 and the FTSE 250. It's a sample which is fairly well representative of those whole indices, both in terms of size and in terms of sector, as you can show there, as you can see. We've got 38 new policies out of the 100. So anytime we're talking about policies, that's the sample we're looking at. And interestingly, when we looked back at when we've done these in previous years, what we have found is that this sample is broadly predictive of what the overall AGM season outcome will be when we come to update you in September. So it's a pretty robust sample to understand what's happening in the market. It might not be exactly the same, but it's a good indicator of what we might see. And just before we move on, a large number of these were published in the last couple of weeks. You know, the December year ends, you get that flurry. And so I just want to pay tribute to our team who have helped put together these slides. Helen, Hector, Harry, our research team who helped us with this. It's a fantastic job. We're really grateful. Very quick piece of context before we get into this. So what is the context for this year's AGM season? So if you go back a couple of years, we had the beginning of this concept of a big tent debate on executive pay, coined by Julia Hoggett, around competitiveness of the UK in sort of global markets as it becomes too restrictive, too onerous. We headed into the 24 AGM season last year, and we did get some emerging signs around pushing in areas of quantum, changing incentive structures, things like hybrids, changes to bonus deferral, some other things that were happening partially in response to some of those themes. And then, of course, in October last year, we had the delayed and then ultimately published update to the Investment Association guidance, which again reflected a lot of that, picked up on some of those themes, changed the tone a little bit, a bit more flexibility. And so what we've been sort of testing, what we're interested to test this year and think about is whether some of those themes have continued to embed or perhaps they've slowed down. You know, where are we? So that's the kind of context that we are looking to pick up. We're going to start with salary. We've got quite a lot to say on salary, so we'll try and whistle through this pretty quickly. So first of all, employee increases. Why do we look at employee increases? Because it's obviously an important reference point for executive director increases. Cast your mind back a number of years, it was pretty common in the UK that non-employee increases might be 2%, 3%, somewhere in that range for many years in a low inflationary environment. 2023, we had a big uptick in inflation, cost of living pressures, and all employee increases jumped significantly, as you can see in the chart. We had a bit of a downward movement last year, and that's continued into 2025. As expected, really, with a low inflationary environment, slight less pressure on cost of living. And so the median workforce increase in our sample is 3.5%. The range is about between 3 to 4%, and it's a big drop off from where we have been. So then how about the relativity of executive director increases to the employee increase? When those employee increases had increased a couple of years ago, we saw a big trend towards what we call discounting of the executive director increase. So that's where the director increase is below the employee average. And there was the pressure that came from shareholders to adopt that kind of approach and not to just roll forward, 5, 6, 7% of all employee increases into your directors. What we've seen this year, and as the employee increases have come down, is that we've got a big increase in the number of companies that are awarding executive directors in line with their workforce. So that's what the chart is showing there for CEO and CFO. It's the split between companies who are awarding the directors above the workforce, in line with the workforce, or below the workforce. And you can see that the big shift here is a lot fewer companies discounting, a lot more companies in line with the workforce. The sort of conventional, historical, traditional approach we used to take prior to 2023. And that's now the most common. So, nearly 50% of CEO increases were in line with the workforce. If you know and you follow our stuff, you know we like to show this chart. We like to get behind the data and look at the line by line. So what this is showing is all of those companies, all of those, each line is a company, and the bar is the all-employee increase, and the little marker, that's the CEO increase for that same company. And what you can see here, if you eyeball that chart, is you can see a lot of companies in line. So the marker is in line with the bar. You can also see that discounting still tends to be most common in the companies with the larger employee increases. So they'll stat here that if you go above a 4% employee increase, you're still finding that about half of those companies are then discounting the executive director increases. And if you're below that, if you look at the left-hand side of the chart, you see that there's a lot more in line. And of course, what you'll also be seeing is there's quite a few above, which we'll get onto now. So this is an interesting theme. So a third of the market are increasing either their CEO or their CFO by an above workforce amount this year. And that's pretty high by historical trend. So it's a big uptick on last year. That's what the pie charts are showing in the bottom there. It's double, more than double what we saw last year. And going back a couple of years prior to that, it's bigger than what we've seen in terms of historical context, which is a pretty interesting, pretty stark observation to make. And so dug into this a little bit more. What are the reasons why we're seeing an uptick in companies going above the workforce rate? I think perhaps there's a bit of pent-up demand after a number of years of restraint at the executive level, generally across the market. I think there is a sort of big tent theme here. In some cases, there's a bit of a talent market pressure, re-benchmarking and finding that you're a bit low and needing to address that. And what we've got in the chart here is we've looked at those companies with an above 10% increase for their CEO, and what were they saying around the reasons they've been pushed to salary. So obviously we've got a big part of it is the performance of the business, both at an individual level and at a company level. There's a very strong role there for market benchmarking, market positioning, either against the UK or against a global peer group. That's commonly cited. And again, talent market pressures need to retain. This concept of pay compression, which is becoming a more common theme. This idea that those who are below the board at the executive level, just below the board, are starting to see their packages increase through market pressure, touch the point where it starts to sort of bump up against what the directors are being paid. And does that create an internal consistency and relativity point? That's being mentioned in a fair few number of cases. So we thought that was an interesting sort of overview of what we're seeing. A couple of other observations that are on this slide. One is we know that shareholders will often prefer bigger increases, and you can see the level of increase, just to be clear, across the top of the chart for each company. They would prefer bigger increases to be often to be phased over a number of years. But actually what we're seeing in this data, in this sample, is that it's not particularly common. We only have 3 examples. We have one with the cross there where they say they looked at it, but then they decided not to do it. But other than that, we have 3 examples of companies that have phased. The rest have not phased. They've just done it in one go. And then the other interesting piece is that if we look at what we've got so far in terms of the ISS reaction to the DRR in which these salaries were reported, they seem so far to be supportive. And we know, the ISS assessment will be against a broad range of factors, not just salary, but nevertheless, interesting to see that these levels of increases, are going through, and they're going through with a reasonable shareholder vote too. So overall, everyone always wants us to come back to the quartiles. What does it mean, sort of net? Just give me the quartiles. So here we go. Here's the quartiles. It's about 3% median. But I think it's, to me, just focusing on the medians of the quartiles here, it probably just disguises some of the underlying that we've been through there. So I think we're probably in a place where, as a general sort of normal rule, we are probably back in the place now with all employer increases lower, where we can go back to that in line. Don't need to be thinking about discounting anymore, unless the all employee increases remains really high. You can go back to the conventional approach. Your default is we can go in line. And also we do need to think about the fact that a third of the market are going above the workforce rate, which again is not always captured. You can see it's sort of captured in where the upper quartile sits. It hasn't fallen quite down in the same way that the median has. But still, there's behind this data, there are a reasonable amount of companies that are pushing above the workforce rate. So that, keep that in mind. Okay, so that's salary, and with that, I'll hand over to Alex to pick us up on the next stuff. You're on mute.
Excellent. Good. I am now unmuted. So
finally, well done.
Thank you. That was a technical difficulty, wasn't my? Anyway, sorry. On to incentive outcomes. So here we're moving on to the annual bonus and PSP and seeing how those compare year on year. Going back to one of the things James said at the beginning, we actually find that this first 100 sample is quite predictive of what happens at the end of the year. So, it's quite an interesting thing to look at. So firstly, on the annual bonus chart there on the left, we're showing the quartiles year on year for annual bonus outcome. And not really very much to say there. So if trends are like in prior years, we'd expect that annual bonus for this year is going to be pretty similar to what it was beforehand. Going on to the PSP, this is a bit more interesting, and it also is probably illustrates why you should never focus on just one statistic, because if you look at the median, looks like the outcome is pretty unchanged, but actually we've had a bit of reduction there at the upper quartile and the lower quartile as well. So given that we like to dig into the data, if we go on to the next slide, we decided to look at what has happened at each company. So I'll just talk through that little chart we have there. So these are the PSP vesting outcomes at each company in our sample. Each bar is one PSP outcome. You've got 4 colors corresponding to the different quartiles. So the dark blue on the right, the top quarter of companies, so those above the upper quartile. The light gray ones on the left are the ones all below the lower quartile. And now the yellow line, what's that? Well, that is what all those bars would look like if we had done this last year. So it's last year's distribution. And if we compare this year, all the gray and blue bars, to that yellow line, we can see that actually we sit pretty much below at all levels. So even though the median is unchanged and the upper quartile and lower quartile are a little bit down, we've actually seen quite a reduction across the whole market, with a little bit of variation. At the top end, if you look at the dark blue ones, the yellow line and the dark blue quite close. So some of the high payers getting similar amounts to the year before. But then if you look in the light gray down there on the left, the lower players getting a lot less than what they were last year. Overall thing is the average vesting is reduced from about 66 to 58%. So moving on to discretion. That's the next slide, if possible. Thank you. Good, excellent. So discretion. Now, this is an interesting topic at the moment, as the IA have said that they are more amenable to positive uses of discretion. And so it'll be interesting to see this year how that plays out. You know, in the past, discretion was really only one way, and that was downwards. And it'll be interesting to see if companies start making positive adjustments to bonus. Now, before I move on to the data that we have there in the bottom right in the chart, what do we mean by a discretionary adjustment? Well, we're looking at changes to the bonus outcome. So you've measured all the, you've done all your performance assessment, looked at the final bonus outcome, and then said, well, I think the performance hasn't necessarily been where we wanted it, or we think it's better than where we think it looks like the outcome is. So we'll make a positive or negative adjustment. We're not counting things like, we're adjusting the bonus for some injection of capital that we didn't, foresee when we set our targets, right? So we're just looking at that other type of discretion. So what have we found in that chart? Well, a little, fewer uses of discretion this year, broadly fall into 3 buckets. So we've colored them differently there. The first one, where you see the largest reductions, just 2 companies, is where the financial targets aren't met. That usually means you get no payout for your profit element of your bonus, and so you either wipe out or significantly reduce the non-financial element. Light blue there, that's just some minor kind of adjustment for pay for performance, tend to be something like a strategic project hasn't been met, so make maybe a 5% reduction to the overall bonus outcome. And then finally, quite a common reduction at oil and gas or manufacturing companies to do with safety, which tends to be in the 0 to 10% range. One there sticks out, the positive, I think it's a plus 18%. So that is an instance of positive discretion. It'll be one to keep an eye on. We haven't had the ISS recommendation for that yet. It's been justified by extraordinary execution of the company's strategy. So that will be interesting to see how ISS come out on that. Previous exercises of positive discretion have been rare, and the last one I saw related to an executive chairman's performance in getting employees out of a war zone. So this will be it'll be interesting to see how ISS react to this one instead. And then finally, no examples of discretion in LTIPs so far. Back over to you, James.
Thank you. So thanks for that. And I think it's really interesting, coming on the back of the changes to the IA guidance in October. So obviously the discretion had always been in as a concept in the principles, but they explicitly said you can now use positive discretion. We see there's a role for positive discretion. It's doesn't always have to be negative. I think what's happening here, though, is that there is still quite a reasonable amount of suspicion in the market among Remcos that actually they don't really mean it, or other shareholders or proxy agencies might not share the IA's view on that. So there's a bit of a suspicion around it, and there's also a little bit of not wanting to be a sort of first mover on the positive discretion. So we'll see how that example goes, because I think over time, I think we are going to move towards a bit more of a balanced use of discretion, but we're obviously not yet there with this initial sample. So thank you for that, Alex. Okay, so let's move on to incentive structures. So around a fifth of our sample have changed the incentive structure in their new policy. It's pretty similar to last year. And we've got actually 2 similar themes than we saw in the changes last year. So the first one is that the PSP is not dead. It's a concept. It's not like that's not working and companies are moving away from it. Actually, what we've got here is a couple of examples of companies moving back from RSUs to a PSP. And it still remains dominant market practice. It's still a pretty healthy, pretty good framework to use in the UK. So that's theme number one. And obviously we've got a few more hybrids coming along here. So last year we had, I think, five or six, and we've got another 5 so far. I think so that takes us now to about 10% in the FTSE 100 using a hybrid. It's lower in the 250, about 4 or 5% in the 250, but it takes to a reasonable number using a hybrid. And we've got some interesting test cases here for ISS. So if you look back to last year, ISS opposed every single hybrid. It's quite well known because that it wasn't, most companies didn't just move to a hybrid, they also simultaneously fairly significantly increased quantum. And so, ISS said we don't like that. What we've got here, we have a couple of examples. St James's Place one, Aston Martin, where the switch to a hybrid is being done with the haircuts, without an increased quantum. So it'd be really interesting to watch how those go through ISS as to whether they can get comfortable with a hybrid as a concept, provided there isn't also what they deem to be an unacceptable increased quantum. So we'll keep you updated on that one. Incentive opportunities. So again, a very interesting theme in the sort of big tent context. We've got around a third of the market increasing incentive opportunities for 2025. If we look first at the policies, it's 55% of the new policies are increasing incentive opportunities. That is up from last year, where it was about 40% of new policies. There is an interesting split happening here. So it is more prevalent in the FTSE 100 than in the 250, which again may speak to this idea that for the biggest, most global or US competitive businesses, which tend to be more in the FTSE 100 than the 250, that's driving some of these changes. If we combine the changes that are happening to policies with companies increasing incentives within their existing headroom, we have 9 of those. We've got overall, that gives us our 30% of the market are increasing opportunities, which again is an uptick from last year. It was about 20. So it's an interesting one to keep on top of your benchmarking. If things are moving, I'll come back very shortly to sort of try and quantify that. We can see that most of the changes are being driven by changes to the LTIP. That still remains most common. Again, probably reflecting some of the wishing to be competitive in the US, where the gap is typically on the long-term equity. That's the most obvious gap to try to address. And reflecting a shareholder preference, I guess, for increases to be in the share-based long-term elements rather than the short-term. We come back on the quantum though. So what this chart shows is this is all of the companies that are increasing incentive quantum. The bar will show the sort of light shading bar is what they had, and then the bit on top of their bar is what they're moving to. And we split it into bonus and LTIP. You can see there's a couple of companies there that are doing both the bonus and the LTIP. And what that shows is that most of the increases are in the 50 to 100% salary range. So not huge, not doubling packages, but sort of incremental increases on what the previous award level was. There are a few pushing a bit higher, as you can see. And what we have so far in terms of the reaction from ISS is generally pretty supportive. We have one against there, but interestingly, that against, so their policy vote was not in respect to the new LTIP level. It was around some of the provisions in the recruitment policy within that policy. So far, fairly benign, but clearly there are a couple. Oh, and there's also, sorry, the one on the far right, that is a hybrid where they haven't done the haircut effectively. And so again, that's just keeping very consistent with how ISS applied their approach last year. And there are a couple of big ones that we need to wait and see how they land into Continental Hotels, Convatec, that we need to keep a watching brief on to see how ISS and their shareholders respond to that. But I think the takeaway is, it's, yes, there's a lot of policies that are increasing, but it's not like everyone's out there doubling their incentives. It is, in most cases, it's incremental. We thought we'd look at this as a theme. So this is around where companies are increasing their incentives. What are they doing in support of it in their disclosure? Which was something raised by the Investment Association. We'd like to see more transparency on benchmarking and on the reasoning and on the talent market reasoning for increases. So what we've got here is these are the FTSE 100 companies that increased incentives by, I think, more than 100% of the salary. So reasonable increases. What are some of the themes we've seen? So each row of this is one company. Okay, so we've seen more disclosure of the peer group constituents, including not just the constituents, but in some cases how those groups have been constructed. So what kind of funnel have you gone down? What kind of process have you taken to arrive at those groups? And some of them might be just one group, like a talent market group. Some might be two, kind of talent group and maybe a US group and a UK group, that kind of thing. But there's more disclosure going on around how those peer groups are constructed and what they look like. Then there's as you'd expect, there's a disclosure on the pay levels. So there's a kind of, here's where we were and here's where we're moving to with our new policy and why that looks reasonable. And you can do that using just the quartiles. You can do it using the line by line approach, which is relatively common, becoming fairly common. There's an example of it that we stuck down there. So it's kind of, here's where our total package was, here's where it will move to. That looks reasonable. That's the kind of idea. And then there are some other things that we're seeing as well. So we talked about this concept of pay compression is becoming, won't be relevant everywhere, but where it is, it's being used in the disclosure. And there were other interesting pieces. So that idea on the bottom right, that's around where the company had been hiring talent from, losing talent to, just to give more flavor of the talent markets in which the company is operating, which I think really speaks well to what the Investment Association are looking for. And I think, from my perspective, you do need to do more now with your disclosure if you are pushing quantum. It's not the same as where you used to just be able to maybe say, we did some benchmarking, we're a bit below market, so we're putting everything up. You have to be more transparent. But my advice on this is that, you don't need to do this every year, which can become part of your normal DRR. I think it's around supporting increases. And critically, you really need to do what is the right thing for your business and not use any of these as a sort of template or that's what we need to do. You need to be more transparent on what you're doing, which still needs to be the right thing, thoughtful approach to your business. That's our advice on that. Okay, so moving into other aspects of policies, the bonus deferral question. So we saw this emerging as a theme in the Big Tent and last year. So the idea is bonus deferral in the UK has become a bit too onerous, potentially too complex. It doesn't apply in other markets, particularly the US. And the way that a lot of companies have been responding is to try to link the deferral to the shareholding guidelines. So if you've already got a big shareholding as an executive, and the reason for deferral is to increase your alignment, well, why do you need that when you're already sufficiently aligned because you already hold a large amount of shares? So that's the approach a lot of companies were taking last year. We've seen that mirrored again this year. So to explain this chart, this shows each of the companies that is making a change to their deferral and how they are linking it all of these are linked to whether you've achieved the minimum shareholding requirement. So if you have, you reduce down from the top level to whatever it goes down to. We have, there's a couple in there who, with the red arrows, where they're doing it a slightly different way. They're saying you don't have to just meet the guideline, you actually have to exceed the shareholding guideline by some factor. And once you do that, you can take it down to where the red arrow takes you to. I think where we're up to now, combining these with where we were up to in the market already, it's at 14% of the market. So it's becoming, relatively common. Again, there's a bit of a split here. So in the FTSE 100, it's up to nearly a quarter are now doing this. less so in the 250. And I think there is a bit of an ongoing debate here around, do you need, if you're going to take this approach, do you need to reduce the deferral, or if you've met the shareholding guideline, or can you completely remove it? And I think what we're seeing so far, if you look at this sample, and if you look at the sample from 2024, it's very common that companies are simply reducing it. They're generally speaking, they're reducing deferral, they're not removing it. That's where we're coming up, that is now majority market practice to do that. So to reduce it to 8% of those will reduce deferral and only 6% remove it. So that's where we're up to on deferral. I mean, I think if you're in a policy review, or you have one this year or next year, it's something you absolutely should be looking at. I'll hand back to Alex.
Okay, so on to banks. Now, there are some interesting things going on at banks, and this isn't intended as a deep dive for FS specialists, but just a overview for everyone else. Now, there have been some significant rebalancing of the packages at banks, which has led to significant increases. And these weren't included in the chart you saw before, where James went over all the incentive increases, because this is in reaction to the removal of the variable pay cap. So this variable pay cap, introduced after the financial crisis, it basically imposed, if you got shareholder approval, a 2 times of fixed variable pay cap. So your combined variable pay couldn't be more than 2 times your fixed. And so when this was introduced, banks had very significant variable pay and were forced to reduce it, and at the same time increased their fixed pay to rebalance it. And now that the cap's been removed, they're going back in the other direction, reducing the fixed and increasing the variable. And that's what we've shown on the chart there. So we've shown both the old and new packages for 3 banks. And in the light gray, you see the basically the cash salary. The dark gray, which is only in the old packages, is the share element of the fixed pay, which was introduced once this cap was put in as a kind of just a share supplement to salary. And those have all been removed now. So that combined cash and share element of fixed pay has gone down and been replaced with bonus and LTIP. 2 interesting points there is that if you look at the light blue bars, which are the bonus, and just sort of cast your eye across that 6 million line almost, you can see that broadly speaking, that bonus level combined with your with your fixed elements of pay is broadly the same. So actually, your annual opportunity, as it were, is being kept broadly consistent. And then instead, the LTIP is being increased significantly. So, in response to the question, what should we do if we're replacing fixed with variable? The answer has been maintain annual pay, annual opportunities, and increase the LTIP. And what does this mean in practice? In fact, there has been an increase in target pay levels at all of these banks to represent the fact that pay is more at risk, and that's been around 20 to 35% increase. Also, shareholding requirements have been increased as well. So that's what's going on at banks. Moving on to another topic, which is quite interesting, is ESG. So ESG been a hot topic for the last 5 years at least. First we saw rapid adoption in the bonus, then a slowing, then sort of a rapid adoption in the PSP, and that's kind of where we are at the moment. But an interesting question has been raised, especially in the last few months at various REMCOs we've been at, in terms of, well, what's going to happen now and why? Well, because of the change in sentiment that REMCOs are feeling from the US. And so this has been something we've been asked to look at. And so what is happening? And we've got a little bit of insight in that from our first 100 sample. And let's say the overall answer is that there isn't much change yet, right? But digging into that a little bit in these pie charts. Now, well, before I do that, what do we mean by ESG? It's always good to have a little bit of time just talking about this, because it can, some companies have ESG elements, then some will put a customer measure in there. Others will say that's not ESG. Some will put employee engagement in that. Some will say that's not ESG. Here we've taken a very broad definition, including everything pretty much, because it's difficult to separate out. And if we're looking for year-on-year changes, it's just easier to put it all together. And these are the results that we've come up with. And if you look at the annual bonus, firstly, well, 84% of companies, no change at all to their ESG element. Yeah, we have 5% actually increased, and then 11% reduced or removed. So whilst most are doing nothing and some are even increasing, it is interesting to see a few reducing, and even I think two of those completely are removing it. Which is not something we've seen so much in the last few years, but also we had seen a stabilization of ESG, a rapid increase, and then sort of a flattening. So I'd say not much change in annual bonus yet. And then if you go on to LTIP, again, quite a few with no change, 12% there in the middle blue, basically increased, and I think even 5 introduced. So we're actually seeing even more in PSP than we did before, but then that is balanced somewhat by 12%, which reduced it. So yeah, overall, it seems like no change yet is the answer we've got out of the first 100, but let's see, let's see what happens. Moving on to the next one, so NED fees. So 2 topics here. First, NED increases. So as the strapline says, 66% of the first 50. Now I should say first 100. I didn't just stop counting at the 50. We did go into the whole 100. So 66% of the whole sample increased net fees. This is a little bit lower than last year. So fewer increasing. And also, if you look at the little chart in orange there, you see that the typical increase was around 3 to 4% for board chairs and for the NED base fee. That's a little bit lower than last year, where it was close to 4 to 6. So similar trend to what we saw for executive directors, down year on year. And then on the right, we looked at time commitment. Why did we look at that? Well, the IA talked about time commitment and fees being commensurate with time commitment, and also suggested that companies should disclose what the time commitment is. Now, so we looked at the companies in our sample. We actually only found 5 which provided any disclosure, and we've listed extracts, little quotes there. And so those are 5. And the ones with the red stars actually are ones which were companies which were already disclosing it the year before. So 4 out of those 5 actually had already been saying what the time commitment was, and there's only 1 new one. So we haven't seen a big change yet in practice, but it is interesting to see what they're disclosing, because it's pretty generic in some sense. It is well, it looks like, and in some it's actually stated to be, the extract from the letter of appointment, that this is just the time commitment that we expect when ADs sign on for the job, which is all well and good, gives us a little bit of insight to what that's supposed to be. But if the intent is to use time commitment as justification for what the NED fee level is, a little bit of information might be required into how much, how many board meetings or actual other trainings and things that NEDs are spending their time on than just this. But there we go. Over to you, James.
Thanks, Alex. And I mean, it's not an area I think that people probably find the most exciting, net fees, but I think it's interesting. If you go back to our, which one was it, 23 net fee report, we sort of took a step back and wrote a bit of a thought piece on this, sort of saying, time commitment has generally increased, widely acknowledged to have increased. Risk and complexity of the role, other types of opportunities, private companies have other roles. Net fees are much lower than they are in US companies. Nets are globally mobile. Look at that. And the Investment Association themselves having recognized in 2023 that, and explicitly recognized, fees have not kept up with time commitment. And we had sort of postulated at that time, I think there might be some companies looking to do a real reset of net fees. And we're not seeing it. We're not seeing it at all. We haven't seen it in the 2024 updates to fees, and we're not seeing it yet in this first sample of the first 100. So interesting. let's move on to a couple more things on disclosure. Try and be quick on this one, fairly dry. So the first one is that the code was updated with effect from 1st of January 25 to say that you need to explain when if you've used malice and clawback in the year. And there's a small handful of companies who went early on this because they didn't need to report it last year, but they did, and they're doing it in the interesting thing we thought is they're doing it in very different places, but generally speaking, it's pretty much just a boilerplate saying we didn't use the malice and clawback. So when you're preparing this year's annual report and you do need to comply with the code, it's really not much to say other than that small statement. The other thing, which is not part of the first 100, but it is a change we've come across in the last couple of weeks, which is draft legislation to unpick some of the things which went into the DRR regs in 2019 to comply with the Shareholder Rights Directive. There are various small things in there. The most interesting one, I think, for reward professionals is there will be the removal of the table that does the annual change for 5 years, annual percentage change for 5 years for each of the directors and the annual employees. That's coming out, which is great news, I think, for everyone, because I think we can all agree it's highly time consuming. I'm not sure it adds any value to any stakeholder in the business. So that's coming out. We would expect it will be applicable once it's approved. So if we get that approved in 2025 as new legislation, it will be then applicable for FY26 December year ends. So watch this space for when that approval happens. Okay, windfall gains. So this is an interesting issue in the sense that it was very live with COVID. Go back a couple of years, and this idea that if your share price drops rapidly over the course of a year from your previous grant, and you grant the same percentage of salary, you will grant a larger number of shares because of the maths. And then if there's a very quick rebound in the share price, you could create what some shareholders might perceive to be a windfall gain. And lots of companies originally thought, well, we'll address that with vesting. And what shareholders then said, well, we prefer you to address it at grant. So if you have a drop in the share price, you should look to adjust the grant level to remove the risk of windfall gains. And last year, 24, we didn't see, so this time last year, so when we were looking at the 23 financial years, we didn't see a huge amount of evidence of any companies doing this, reducing at grant. This is the latest sample from our first 100. So what we're doing is we say, let's have a threshold. If your share price fell for your grant that you did in 2024 by 30% or more, which is a reasonable sort of threshold, I think, to start thinking about this issue, what did you do? And so that's what the chart shows. So we have 9 companies where the share price fell by more than 30%, and 4 of them did make an adjustment on grant. And you can see the levels of adjustment underneath the table. 14, 17% down, 7%. These will be relative, right, Alex? These are relative adjustments.
Correct. Yeah.
And so that's quite interesting. So it hasn't fallen away as an issue. There are still companies who are looking at this and making adjustments. But equally, 5 companies in there, the light blue, they didn't make an adjustment. And from what we can see so far, I mean, it's very early in the season. This is not something that ISS are picking up on and calling them out on. So I think it's something to be aware of. It's an issue that's still around, but it's still complex, and there are still mixed practices. And it's something to take a really thoughtful approach to. I don't think there is a rule or an algorithm which will help you here. You need to take a really thoughtful approach if you're in this sort of situation. Okay, so the DRR voting trends so far. Now, the problem here is that we've only got 20% or so of our sample with a DRR out, with an ISS report out for their DRR yet. So, we have to take that with a pinch of salt. But so far, based on that sample, 20% of the sample, it looks like it might be similarly benign season to what it was last year. and then drop off in ISS recommending against. And I think there will be some this year, but we have to, let's take a wait and see approach. But so far it looks similar. Now, we didn't want to leave you with nothing on not saying anything about voting and about ISS. So we thought we'd share this. This is our final thoughts, which is an interesting piece of analysis we have been thinking about and working on. If you look at this chart, what this chart shows is all of the policies since 2019 that have had an ISS recommendation against and a vote below 80%, so below the significant vote against. And that's all of them. And the chart shows what their policy vote was. And then the ones shaded red are where in the year after that policy vote, they also got an ISS against for their DRR. And what we're sort of showing here is, seems like ISS have a sort of threshold around 70% or sort of 65%, where if that's what you got on your policy, you're also likely to then get them to vote against on the DRR the following year. And that's why I call it sort of hangover. So you have a tough policy vote, and then it rolls over to the DRR the following year. And this is something that can be really exceptionally frustrating for companies, on the basis that they feel like, we've done the policy, we've done a huge consultation, we haven't got everybody to support us. These are complex issues, but in good faith, we engaged, we got the vote across the line, we met the required threshold under the law, we won the vote, and yet it carries on into another year. If you look at if we want to test that hypothesis, so our view, which is, if you go below 70 or sort of 65, you should expect an ISS against the next year. If we look at the low policy votes last year, they're in the table on the right-hand side, and we've got two so far where we've had the ISS DRR report for the following year DRR, and that's for AstraZeneca and Smith & Nephew. So they got policy votes of 64, 57 last year. So you might think, well, they'll be in the camp of getting an against, and they haven't. They've had support from ISS. So that's, it's only two, but it's just an interesting, is there a bit of a softening here from ISS on that position? So we'll wait and see how the other ones do. But our view as a practice is that will be incredibly helpful, is if policy votes might need to be against, that need to be a low vote, companies need to deal with that, but the idea that it just keeps continuing for subsequent years is really challenging. And so if that does suggest there's a softening, I think that'd be really welcomed by the market. So we'll keep a watching brief and let you know. And that is everything. So appreciate that's been a very quick whistle-stop tour. I don't know whether there are any questions, Alex?
Not that I can see at the moment in the chat or Q&A.
Okay.
One question now, though. Do we have any data around the payouts of ESG metrics in the short and long-term plans?
We do, and we looked at this at this time last year.
Yeah, we did, yeah.
Where I think our conclusion on that was the payouts were typically slightly higher for the ESG metric, but perhaps not. I think there's a shareholder skepticism that the ESG metrics are soft and they always pay out really high and much higher than the financials. And I think when we tested that, we said we sort of concluded maybe a little bit, but it's not compelling. There were a lot of companies where the ESG outcome was broadly similar to the financial, or even lower in some cases. I think it's an interesting question, and it's something that we will It's something that we will look at. We'll probably look at that for September when we can look across the market. Because I think one thing that was a challenge in our analysis last year is we didn't have enough LTIPs yet, because there wasn't that many ESG metrics in the LTIPs back in 2021 whenever we were looking at samples. So now we'll have more. So we'll have a bigger sample to test that hypothesis. And we'll come back to you. That's probably something for our September update when we look at the market.
Indeed. Another question, any thoughts on current share price volatility and regarding the upcoming share awards for our windfall gain slide? So I guess companies, who currently, we didn't necessarily expect this 3 weeks ago, right? But suddenly situation's different.
Yeah, I think it's one where you do need to get into the testing. So you do need to have a look at, what's the drop that we've seen from last year's share price. What would that mean for the number of shares? And I think part of it is a view as to whether you feel that the reduction in share price is a sustained sort of macro event that you think is likely to impact the company for a number of years. It's the new normal for the company, versus we actually think this is real short-term volatility. We've dropped 20%, but we think we might well recover that in the next couple of months, because the market will realize that we're not as impacted as we thought. In which case, I think you are at much greater risk of a windfall gain. So, I mean, we've got, and we can share, I'm not sure you asked the question, we've got a detailed user guide on windfall gains that goes through this, because as I said, I don't think you ever solve this by saying, here's the formula that gives you the answer. There's a lot of things you need to think about, and including some of this market data, which is quite interesting. So half the market doing it, half the market not doing it, and take a view. So yeah.
Very good. And those are all the questions so far.
Okay, that's great. So we'll give you back 5 minutes. As I say, what we'll do is we'll share the recording and we'll share the slides, and we'll see you for our next webinar in due course. Have a good day. Thanks, everybody.